Can I get an extension, please? Yes, today we're going to be talking about taxes. You know, we're rolling into the tax deadline and some of us have been caught unawares. What do you do? Today we're going to be taking a look at some of the nuance of the tax code and some unique strategies to help out potentially some of our listeners, maybe you. All right, guys, welcome to the ultimate crowdsourced personal finance show. This is ChooseFI.
You're listening to ChooseFI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. ChooseFI, your home for financial independence online.
Hey everyone, excited to dive into this week's episode. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, so this episode is coming out April the 11th, and that means it's tax time coming up. It's tax day, right? So normally it's April the 15th here in the US for federal filings, but actually this year it looks like the deadline is actually April the 18th. So anybody listening to this on release day has a week, and you know, that's what we're going to talk about today, right, Jonathan, in terms of, okay, do you have to file then? Can we extend a return? Are there ways to do this? How do you avoid penalties? There's so many little tiny nuances that to somebody who's just completely unaware of this, it sounds complicated, but it doesn't have to be. That's the nice thing.
So we'll get right into this episode, but I just wanted to point out, because I don't think it's been resolved yet. We recently, in an episode within the last month or so, we were talking about your two favorite days of the year. And you...
I'm going to lose one.
You're going to lose... Well, don't spoil it here. And you identified daylight savings, you know, just that aspect of changing forward and backwards. And our bipartisan Congress...
First time ever,
has decided to make moves to end daylight savings. Now, I don't think it's actually, I don't think it's gone. It got passed in the Senate. I don't think it went to the House yet. And obviously it needs to be signed off by the president in order for it to become law. But the reality is we've never been closer over the last, 30 some odd years to ending one of your favorite days, self-professed.
Yeah, Jonathan, this is interesting. So while I will be sad to lose one of my quote unquote favorite days of the year, I guess if this does happen, then under this, it would actually be, so the spring forward, right? That's actually my favorite day because I love when it stays light out later at night. So that I guess will be in effect all year round now. Again, if this does pass. So right, it was passed by unanimous consent in the Senate, but hasn't moved forward since then. And it's funny though, because I've been reading and just hearing a lot of people talk about, wow, this is amazing that Congress actually agreed on something, which seems staggering in this day and age, but it seems like they got it entirely backwards. I guess my thought would be keeping this daylight savings time where it's pushed forward is my ideal. I guess for health benefits, it seems like it is literally the polar opposite. And I actually had two of my favorite podcasters who I've quoted a bunch of times here, Andrew Huberman and Peter Attia, basically saying like, Huberman saying the idea of limiting morning sunlight exposure by permanent daylight savings is terrible.
Wait, so you're saying, I'm thinking more daylight is generally just good. And I feel a little bit bad for the people that have to drive to work every morning in total pitch blackness. I feel a little bad, but that's more incentive to get to financial independence. But you're saying that Drs. Attia and et al. Have some additional input on saying you need to get more morning sunlight?
Yes, that's exactly. And thank you for clarifying. I was kind of rambling there. So right, Dr. Huberman, and he talks about morning sunlight exposure. I think I mentioned this in my FI Weekly, maybe on the podcast at one point in passing, but he's saying that there's vast scientific literature and understanding that our mental and physical health benefits from more morning and daytime sunlight and less light at night. So, and then Peter Attia follows up and said, agreed. I can't believe a collection of such incompetent people, Congress he's talking about, who can never agree on anything, have finally found a way to agree on something that is so totally wrong, which was hilarious.
Like, all right, I mean, they may have science on their side, but let me just say, I was never benefiting from the morning sunlight to begin with. So I'm excited about having a little more on this end. And if it means that I'm going to sacrifice one of my, what's the word, geriatric years, I don't know, one of my silverbeard years, so be it. Anyways.
Yep. Always kind of random. But yeah, it will be interesting to see if this does get passed. And then, yeah, one of my favorite days of the year is gone forever.
So let's come back to taxes, man.
Yeah,
Springing forward, time in the season. So it sets us up really well to talk about this post. This was actually shared by Jared Casaza, who writes over at fifthwheelpt.com. So he's a traveling physical therapist, and he's just resharing, another viral, probably Reddit post. And in this post, the person says, I owe nearly $500,000 in capital gains tax for 2021. However, I lost all my money at the beginning of this year. What can I do? Is it even possible to use my losses to offset the gains, even though it was 2 separate years? So this person just posted it on an anonymous account because they didn't want to be identified. I don't blame them. I started day trading last year, and it was a great year. It was a great year to start. I made 7 figures off of options trading, and I owe nearly $500,000 in capital gains for 2021. In January, I stupidly mistook my luck with an active genius. I thought that I knew how to game Wall Street. I saw the market dip bigly and decided to throw all my money into options again. And I thought it would recover because it always does, right? Buy the dip. I was wrong. The market kept dipping. I lost all my money within weeks. Now I owe taxes for 2021 that I can't pay. I'm 25 years old and my job pays decently, but definitely not enough to pay off $500K anytime soon. What can I do? Is it possible to offset the gain with the loss? Brad, I just have like at least a single tear thinking about this guy's pain. And, we've kind of changed eras where the ability to do things like options trade and day trade can now just be done from the convenience of your phone via an app, and can be done by basically any of us if we want to. And, not only are there the market considerations, but there's the tax collector. And it adds a layer onto this that you don't really think about until you see it all encapsulated in a post like this.
Yeah. My response to this, as my daughters might say, is, oof, that's brutal. I mean, it does bring up, obviously we're using this as a case study. And I think this kind of will help us tie into just understanding the tax filing period, right? Also for, as we're going to talk about, self-employed individuals, making estimated payments, all of these things that are really critical pieces of information that we can kind of weave an entire episode around here. But this is a perfect case in point where this person, very unfortunately, is in deep trouble here, right? For 2021, they clearly have a significant tax liability. And because they lost all of their money in 2022 and they have no ability to pay for this tax liability, this is going to become an issue. Right. And unfortunately, because these are distinct tax filing periods, each calendar year in the United States for us individuals. Now, for companies and corporations, most corporations and companies are on calendar year, but there are fiscal year filers also. So there's some nuance here, but very, very little. For the vast majority, certainly for individuals, we're talking about calendar years, right? So your tax liability, in this case, though this individual had a ton of losses, Jonathan, capital losses in 2022, they can't carry them back to their 2021 period when they're filing. So, this is your SOL type situation. Now, there would be scenarios where they can petition the IRS, they can come up with a payment schedule. So they're not going to prison or something absurd. That's where people's minds go when, I can't pay my taxes. What's going to happen? He'll be able to come up with an arrangement to pay the IRS over many years. But yeah, unfortunately, the way that also capital gains losses work is in 2022, when he goes to file his 2022 tax return in April of 2023, it's not like he can carry all of those losses back to 2021 either. That's an unfortunate scenario where you're only able to offset, in essence, the capital gains from that current year, and you can carry it forward to future years, but you can't carry it backwards. Now, that, again, there's always nuance, Jonathan, right? So people might know when they're talking about corporations, there are ways to carry back losses. So with corporations, you can carry back net operating losses for your entire business. So there actually is a distinction. And I do want to make that clear, even though it's probably a little more nuanced than most people need for individual returns, certainly. But just in case they've heard, oh, but that company carried it back. Why can't I? Unfortunately, those are the rules, right? So net operating losses can be carried back depending on whether it's federal or state. For the corporation, it's usually a couple years back that you can carry it, and you can carry it forward for 15 or 20 years. But unfortunately, for individuals, we do not have that ability, or I've certainly never seen that ability before in any regard.
So in terms of parsing that and what it's probably going to mean for this individual, they're going to need some professional tax help. They're probably going to be able to structure some sort of payment plan. It's going to be a means tested payment plan. They're probably going to need to file an extension just to get it all sorted. Because if they're listening to this, depending on when this was all done, it's going to be a little bit complicated to set up. But the other thing that comes to mind, and you came around to it, but I just wanted to highlight it for people. So he has a capital gains tax. And so what we were talking about was, well, now in 2022, can he file capital losses? And so while his capital gains were on the profit from the sold assets, the capital losses from 2022, how much he's going to be able to deduct each year is going to be $3,000. And so if he has a $500,000 loss, I believe, Brad, he can kind of stretch that out over many years so he can get a $3,000 a year deduction, right?
For 167 years.
How is it you're still getting this $3,000? But we'll come back to the extension idea in a few minutes here. I think, Brad, this really sets us up just to talk about maybe the unseen or hidden dangers between moving in and out of large positions outside of your retirement accounts.
Yeah, agreed. And just the last piece of actionable information on this particular scenario, and I think it's really important, is in a scenario like this, right, where this person had huge gains in one calendar year in 2021, right? And they just said, let it ride, right? And subsequently lost everything. Really, what you need to do is you need to put aside a portion of that money for taxes. You just have to. If you have large gains and you're not financially independent. Like for me, if I had $100,000 or $200,000 of gains and I owed 20% tax on that, right? And so it's like 40 grand in taxes. Even if I lost all that money, I obviously have other assets and I wouldn't be in a dire scenario. But for someone with no other assets, this is it. And you have significant gains that are going to be taxable, you have to put that money aside. Just very simply. Really, the easiest way to kind of idiot-proof it so that you aren't in a scenario where you can just screw your life up is you should send estimated tax payments. And I know, Jonathan, we want to talk about that in depth, but you need to just mail that money off and not have control of it anymore. That's really the easiest way so that you can't screw your life up. But for most of us who have some ability to say, okay, I'm going to squirrel this money aside and put it somewhere safe, however you deem safe. And maybe you could get a small interest rate, even just an online savings account at whatever they give now, 0.5% interest if you're lucky, but still it's better than nothing, right? If you have the ability to say, I am not going to spend this money, this is for taxes, and I can put it aside and earn a little bit on it, then you should do that, right? But if you don't trust yourself, then I would just send this money off to the federal government and to your state in terms of estimated payments. And again, there is nuance there in terms of avoiding penalties and things like that. And Jonathan, we will talk about that throughout the episode. But that I just wanted to say, because it's really, really critical that people don't get in a scenario like this.
So it also comes to mind as we're talking through this, like this is a particular danger for people that are looking for home runs and people that are taking advantage of leverage vehicles, which can amplify their returns, and people that are really speculating versus investing. If you're looking for the perfect time to get in and the perfect time to get out, and you're doing this in a non-retirement account, a non-shielded retirement account, if you hit a home run with something, like you make this investment and it 10Xs, all right, I'm very happy for you. We're all very happy for you. But the problem with a lot of these speculative investments is when you got into it, you knew that you were going to try and sell it to some sucker that was going to pay more and you were going to try and get out, right? Because you didn't necessarily believe in the long-term stability of the investment. You more just know there's an opportunity here. It's been squashed because of this. So I'm going to get in here. And then when I get back to here, I'm going to get out. That is an all in or all out scenario. And that is a massive taxable event. And when this is happening not in a retirement account, this is an important distinction. If this person had done a version of this inside of a retirement account, Inside of the retirement account, it does not incur capital gains, right? But this is happening in a taxable account. It's just really important to understand the nature of these. So when you're doing this in a taxable account, him deciding, I need to get out at this time because it might go back down, whatever. You could imagine, kind of like a GameStop short squeeze, and all the people that sold it at $400 are very happy, and now it's back at $100 and they feel like they got away with something. But then they took it out of GameStop and then they threw it right back into AMC, and then AMC dropped it. That's what we're talking about. That's how this happens, right? Because you had to get it out, because if you hadn't gotten it out, it was going to go back down. You knew this was a point in time because you're smarter than the system. You knew it was a point in time. And then you rotated your money out of one quote unquote speculative investment or asset class into another. And then your genius got in the way and you tripped over your own legs. This is how this car crash happens.
Yeah. And this is such a critical piece. And unfortunately, even over the 5 years of the show and any other personal finance media that I've ever heard, like, we haven't come up with a good way to describe taxable accounts and retirement accounts. It still sounds confusing, but like you said, if you have money in a retirement account, so think 401k, think IRA or your Roth accounts, as you said, Jonathan, this is really, really, really important. The tax event or deduction happens at the time of contribution and the time of withdrawal from that account. So let's look at a regular 401k, right? You put money in and you get a tax deduction for that in the year that you contributed, okay? And then, as you so aptly said, no matter what happens in that account, you get dividends, which might normally be a taxable event if it were in a quote unquote taxable account. And again, I'll talk about that in a minute. But you sell something, you would incur, in a normal scenario, you would incur a capital gain if it was an appreciated asset. That's not a taxable event in a 401k, okay? What is the taxable event is many years down the road, when you take some of the money out of that account, that is then a taxable event. And the amount of money that you took out is subject to ordinary income tax rates, assuming that tax law doesn't change between now and then. So that's the critical thing. And then with a Roth, it's the opposite, right? You have no tax deduction when you contribute, but then down the road, when you pull the money out, there's no tax liability. It is not a taxable event. So again, it's contribution and withdrawal is the only time you really need to consider the tax implications for a retirement vehicle, okay? But as you said, with your normal investing, which in all of our brilliance, we call taxable accounts, which just sounds stupid, but it's your normal investing, right? All the money that's left over, that's where you have to really, really consider this. And like you said, Jonathan, for most of us with a long-term mindset, we're maybe putting money in index funds or individual stocks. You're not going to get in a make or break for your entire financial life scenario in most cases, right? In 99.99% of cases. But when you're talking about this speculative stuff, when you're talking about, I've seen it in the crypto and NFT world where people just hit these magical home runs and think they're brilliant, just like we're describing here with this person, and they don't put money aside, they subsequently lose everything. It's the exact same scenario, right? That's in your regular taxable accounts because it's your regular money. That's just outside of retirement vehicles. And therefore, capital gains will be on this year's tax return. And that's where you're getting into a scenario where you could screw up your whole life if you don't put money inside.
People don't really appreciate this. This is why people don't actually buy anything with crypto. Like, if you really think about it, they don't, like, there's a Bitcoin conference right now. Everybody bought their tickets with US dollars. Why? Because they don't want to incur the taxable event. Think about that.
Yeah. It's funny. I actually did a podcast guest appearance on a podcast called NFTs for Newbies. And it was a 2-part series on the tax implications of NFTs and crypto. And it's exactly that, because cryptocurrency currently is not considered currency. It's considered property. Anytime you transact in it, there is a tax implication. So if you literally bought something, like you said, if you bought a ticket to a conference with Bitcoin or Ethereum or something, there's actually a taxable event because it's treated as if you sold your asset. It's crazy. So, I mean, I'm
not proud of the United States for this. We're like a business. No. This is shocking. Like, maybe our politicians could get bipartisan on some better regulations around this. It's not ideal. It's not admirable. No. It's nothing to look at. It just is right now. And we're in kind of a state of regulatory purgatory when it comes to these things. And you just need to be cognizant, because it does. I think here's the key. Like, we're going to come back to the core idea, but long-term investing, don't buy something that you don't want to be in for more than a year. The people that bought Bitcoin are not really using it at this moment because of all the friction with these, but they believe, whether I agree with it or not, they believe that long term, once we get on the other side of the chaos that we're experiencing with these regulations right now, it's going to be something awesome. It's a long-term investment. But man, when you get this meme coin and you move from one meme coin to another and you hit a home run, look at this scenario. This scenario is a perfect case of how a real blessing can turn into an unimaginable curse that haunts you for decades. Best year ever, worst year ever, best of times, worst of times, glass half full, glass is shattered on the floor.
And like you said, best year ever, worst year ever, you can't net those 2 years to zero, right? So that's really the big takeaway.
Hey, this is Andrew from the ChooseFI team. Hope you're enjoying the show. We're going to get right back to it after these quick messages.
Yeah, I mean, I think we should kind of pivot now into, okay, how can we talk through this consideration, right, Jonathan, of discrete tax years in terms of individuals like me and you, many people out there who are self-employed or own their own business or have 1099s or a side hustle, whatever it may be. How do they consider paying their estimated taxes? What can they do in terms of extending the filing of their tax return? What's the implication for paying your tax in terms of when you get an extension, all these things? I think this is kind of the meat of, hey, how can normal people out there, and like we just spent 15 minutes on, I think that there are implications for people listening to this podcast, and that's really important. But I think this will be more applicable to really a broad swath of people.
So what's interesting is there's a tool that we're going to talk about, and there's nothing wrong with it at all. And we've never really talked about it on the show. And it is that you can file if you need to. You have the right to file for an extension. There's a process for that. It's not particularly difficult. And it would take whatever the normal date is, which normally historically has always been April 15th. The last 2 years, there's been some pandemic adjustments, but it takes that and it pushes it all the way out to October 15th. It's very simple to do that. You can do that on the IRS website. Nothing wrong with it at all, but there's considerations about what it extends and what it does not extend. And so, Brad, I'll give this back to you.
Yeah, this is really important. And whenever we're talking about tax, there's always, in essence, 2 returns that you're filing. If you're a United States citizen, you're filing your federal 1040 for the vast majority of us, and then you're filing your state tax return. Now, there's always slightly different rules in terms of the dates your returns are due and such, but it's probably easier, Jonathan, for us to just talk about the federal return. So whatever state you're in, there are also extensions, but you just need to quickly Google, like I would Google extension of time to file Virginia tax return, whatever it is, right? And it'll just give me the exact form I need to file, and it'll tell me the precise dates that it was due and when I get my extension to. But for the sake of simplicity, let's just talk about the federal return. So like you said, most years, April 15th is the tax filing deadline. So most of us think come hell or high water, we have to file our return by April 15th. Now, that is not entirely true. So like you said, there is an automatic extension of 6 months. But you do, while it is automatic, you do actually have to file a form.
Yeah. And Brad, I went ahead and looked that up, the actual number of that form in the IRS tax code. It's form 4868. And as you pointed out, each state potentially has a writer form that goes along with it. Some of them, they just fold it into the 4868, and some of them, it's something extra that you have to do. Virginia automatically grants all taxpayers a 6-month extension. So it just depends on your state.
Yeah. And the absolutely critical piece here is that this is an extension of time to file your return, but it is not an extension of time to pay your tax. Okay. So this is as critical. If you take one thing away from this episode, this is the thing. So while you do get time, you get those extra 6 months to file your as close to perfect tax return as you can come up with, you do have to make as close of an estimate of your tax liability by April 15th and make sure you are paid in. Okay. So when I say paid in, for most of us through our normal W-2 employer, we obviously have withholding every pay period, and you would add that up. That's your withholding, and that's your payments on file for that year. But as we're talking about here, for small business owners, for people who have 1099 income and the like, you most likely have to make estimated tax payments throughout the year. Okay. So you are required to file these estimated tax payments. You can't just pay zero and then pay it at April 15th and say, no harm, no foul, we're good, right? There is an underpayment of estimated payments penalty that you need to avoid. So that's the key in terms of making quarterly payments.
Right. And so that's the key there I want to get to. So in that form 4868 in part 2, there's really like 4 different places that become very obvious and pertinent for this conversation. Question number 4, you estimate your total tax liability for the past year, so 2020. Number 5, you provide to them how much you actually paid, so your total 2020 payments. And then number 6 is just subtraction. You say your balance due. And then number 7, the amount that you're paying. Now, if you make this estimate and then it turns out when you actually file that, you owe significantly more than that or any amount more than that, you are probably going to be subject to a couple different things. 1, potentially an underpayment penalty. 2, a late penalty. And 3, interest on the difference between the time it was supposed to be filed and the time that you actually filed. So you just need to be aware of these. This is not a get out of jail free card, and it's not an interest-free loan. But this form is a mechanism for you to push back the date that you have to. And keep in mind, a lot of people, very, very astute accountants, will file for extensions. Not to get an interest-free loan, though, but because while they have paid what they believe is their best estimate of what they are going to owe, they are scratching around for every deduction that they can get to reduce their tax bill as much as possible. And the extension is a mechanism for them to continue after they have all the information, look for additional ways that they're going to be able to optimize this thing so that they're going to, pay the least amount that they are legally obligated to pay, which I think is a righteous movement.
Yeah, right. I didn't see you going there. But yeah, that is absolutely correct. You should do everything you can under the law to file your tax return accurately and as advantageous to you as you can. So it's interesting because I have 2 responses to what you just said. So in my case for 2021, I actually am extending my filing because, like I've talked about a little bit here, I've been dabbling in these NFTs and crypto just kind of for fun. And there's a lot of nuance to filing a tax return properly with this stuff, which is really, really annoying. And it's just a lot of detail and I don't have it finalized. So in my case, I'm not scrounging around for extra deductions. I'm just looking to accurately present my tax return as closely as I can. And I have a general sense of what my capital gains or losses may be, but I need to really lock it down. So again, when you file an extension, you're trying to come up with your best approximation of your tax liability. So I'm not stressing about every little dollar on this dopey NFT stuff. I'm just trying to get a general sense of what's my potential capital gain exposure. And then I add it to all the other stuff that I've already filled, my W-2 or K-1 in our case from our small business, or my 1099s, et cetera, 1099 interest and dividend. I've already pre-populated all that stuff and I'm just waiting for this last little bit. So in my case, I'm extending because I just want to accurately present my return. Now, Jonathan, I have a kind of advanced level thing to do here, which you might benefit from since you're in a similar boat in terms, I believe, of extending. So for small business owners like us and many people out there who are self-employed, so if you are extending your return, now I have some additional tax due, right? So I know I need to make a payment with my extension, right? So the 4868, I'm going to mail in a payment. Now, I also have to make a first quarter estimated payment for 2022, right? Because as I said, because I'm a small business owner, I send in estimated payments quarterly to the federal government. So what you can actually do, which is really cool, is you can make your extension payment and add the 2 of them together. So instead of sending a Q1 2022 estimate, in my case, I'm going to lump them together into my extension payment. Now, it would be at almost the exact same time because the deadline dates are the exact same, okay? But what happens here is it gives me a little bit of safety on potentially exposing myself to those penalties that we talked about. So let's just say hypothetically, and I'm making up numbers off the top of my head, I would have sent in a $5,000 extension for 2021 and a $10,000 first quarter 2022 payment. Instead of doing that, I am going to send a $15,000 extension payment and a $0 Q1 2022 payment. Okay. So now what happens is when I file my tax return, anytime between now and October 15th for 2021, I'll figure out my exact tax liability. And what happens, because I made that much bigger extension payment, I'm going to have an overpayment. Now I can either refund that or I can carry it forward to 2022.
Will that be, you'll get a notice from the IRS that you overpaid?
Well, it's actually on the 1040. So you'll see that on the 1040.
Okay.
It's most of us just reflexively refund our payments because that's what we do, right? We've overpaid, we get a refund. That's what you do. But you can carry it forward. So now let's use the scenario.
But that wouldn't happen till, in this case, October 15th, if you were to take the full window, right?
Correct. But because it's an overpayment from the prior year, it counts as if it were essentially January 1st of 2022 or
cool.
Q1, right? So the beauty of this and why this is advanced level is, let's say my tax liability for 2021 actually went up being higher than I expected, right? But it's somewhere between that $5,000 that I thought I owed and the $15,000 that I paid. Okay, sure, my now overpayment carried forward to 2022 is a little bit smaller than I anticipated, but I'm not on the hook for a penalty from 2021. So it's that little genius move of just knowing. It's not genius. It's not genius at all. It's just literally knowing that this is something you can do and you should do if you were going to send them both in at the same time. So does that make as much sense as it makes in my own head, Jonathan?
That is as close to an IRS tax hack as you can come up with. That's pretty cool.
Yeah, not too bad.
I am curious. So what about the scenario where someone estimates their total tax liability for 2021? They filed the extension, and then within the intervening months, they realize, oh, snap, it's actually, several $1,000s more than I was anticipating. And recognizing that there is there's an underpayment penalty, there's interest that's being, they could wait until the final filing, but they're like, I want to minimize, how much interest I'm paying in the intervening time. Is there a way that someone can then retroactively just make additional payments to play catch up ahead of doing their formal filing to get that estimate a little bit closer?
Yeah, I don't think so. That you're taxing my own knowledge here, Jonathan. But I don't think there's a scenario like that. But I do have two responses. One is really critical. So the first would just be, okay, as soon as you file your return, in that case, if you did owe a significant amount extra, most likely you don't want to be on the hook for that interest. So you'd want to file your return as quickly as you could. And you can make that interest payment, which your tax software will calculate for you. You can make that interest payment with the return. Now, and this is not financial advice, so please, but this is my own experience and what I would do in this scenario. So while interest, there's no way of getting out of paying interest. Oftentimes, you can write a letter to the IRS asking for what's known as an abatement of the penalty. Okay, so basically just asking them to kind of nullify the penalty or waive the penalty in this one instance. Now, this is a very standard practice for accountants. We write abatement letters all the time requesting an abatement of that penalty. And you just explain your situation. Hey, I made a good faith effort to calculate my liability. And as you can see in prior years, I've always paid on time and in full. You paint a nice picture. This literally will never happen again. I completely understand the situation now. I respectfully request an abatement of the penalty of X, Y, and Z amount, whatever it is. And again, not financial advice. I can't guarantee this, but in my experience as a CPA, I've seen the IRS grant abatements in probably 80% of the scenarios where I send a letter like that. So I would never, because penalties do not increase once you've filed and paid. So there's no downside to you. It's not like you're on the hook for more penalties in that scenario. So in your situation, Jonathan, where you said, okay, you requested an extension, you filed, let's say in June or July, and you realized, okay, I owe more money. I would pay the interest personally that was calculated in TurboTax or wherever, but I would not pay the penalty. I would zero that out. And again, this is me. And I would wait until that penalty notice came in the mail from the IRS, and in which case I would then respond with my nicely worded letter.
Nice. Which I think everybody has a template for on this call. So you can just get that transcribed, give that a shot, and maybe there's something there. And hopefully, and I think the key part of that though, Brad, is like, hey, whatever happened, if that did happen, what is the system going to look like so it doesn't happen again?
Right, exactly. Do not let that repeat. And that kind of ties into another important nuance. And it's in terms of making your estimated payments. Okay. So this is yet another really critical piece for small business owners and people with side hustles and self-employed is, okay, a lot of times for most of us, our income, right? Our 2022 income is completely unknowable right now. Your business could explode or your business could go to zero, right? And I couldn't tell you today at the end of March when we were recording this, what my tax liability is going to be for 2022. I might have a sense, but I want to make sure that I'm paid in terms of those estimated payments so that I'm not setting myself up for those underpayment of estimated payments penalties, right? So what's cool is there are what's known as safe harbor payment options so that you basically can be in this scenario where it is uncertain. And the government understands that, right? They're not monsters in this scenario. Like they understand this is uncertain and there are ways to cover yourself so that you're not getting hit with those underpayment of estimated payments penalties. And you obviously then just true it up when it comes time to file your tax return. But what I do, so I'm going to read this now from an article, which is the safe harbor estimated tax has three components, which they'll outline here. So generally, an underpayment penalty can be avoided if you use the safe harbor rule for payments described below. The IRS will not charge you an underpayment penalty if you pay at least 90% of the tax you owe for the current year. And my editorial on that is that's the part that's very hard to know, right? Or 100% of the tax you owed for the prior year. Okay. So that, Jonathan, is really the critical piece because that's known, right? So in 2022, I know what my liability was for 2021. And I can just say, okay, 100% of that, I divide by 4 and I send my quarterly payments, right? So that's actually really, really simple. And then if you had a blowout year for your business, okay, well, like I said, you put that income on your tax return for 2022, a year from now, and you're going to owe a bunch more tax as you rightly owe, but that's at tax time. You don't have, because you paid in 100% from the prior year, you don't have to worry about that penalty. You just have to pay your tax as you normally would, but you're not going to get hit with penalty. And the nuance is the rule is slightly altered for high income taxpayers. So if the AGI on your prior year return is over $150,000, you must pay the lower of 90% of the tax shown in the current year return, which again is unknowable, or 110% of the tax shown on the return for the prior year. So again, it's not that hard to figure out. It's just really simply, if your AGI is over 150,000, if you're a high income or moderately high income taxpayer, you owe 110% of the prior year. So you just look at your 1040 from the last year, go to the liability, you multiply that by 1.1, right, to get your liability, and that's what you pay quarterly. So as long as you do that, you do not have to worry about those underpayment of estimated payments penalties. So I know, Jonathan, I got into a little bit of CPA nerdery there.
I think it's helpful to kind of, if you're gonna have a nuanced conversation, make sure you layer in just a lot of different factors. I think it's gonna be really helpful for people to know this stuff. I mean, to know that this form exists, that this process exists, what it's going to help with, what it's not going to help with, and also those, especially for small business owners, those estimated payments, the safe harbor provisions. I think this, and even the penalty abatement text. I think it's a very useful tool set for people to have because the IRS is not going anywhere. Hey, I think for people that are interested in that extension, that Form 4868, it's probably worth knowing that can be filed online at irs.gov. That would be something to keep in mind.
And just a further nuance. So we're talking about estimated payments and paying. In the olden days, you had to mail in a check and you had to print out this voucher and send it in. The site that I use is EFTPS.gov. So that's the electronic federal tax payment system. And you just set up an account. I would not do this on April the 14th. I think there is a way that you can set it up last minute, but that's not something I want to get involved in. When again, you're a small business owner, just set this up. Go and apply for an account. You put in your information, you link up your bank account, and then it's super simple from there on.
Awesome. All right, my friends. Well, wasn't this episode a bundle of joy? So much fun. I hope you're as excited as we are. And hopefully our Congress will protect us from daylight savings if we're lucky. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.